as well. Madhavi, thanks for joining in. And 2 points that Aradip made, which I would want to get your view on. One, that it may not be a complete given that there is rate action. I differ, but Aradip is the more informed one and the more intelligent one. So I would love to get your opinion on this. And two, is the policy commentary going to be a lot more about what the RBI does with regards to the rupee as well, or not quite?
Hi, thank you. So I don't think I'll start from the last bit. I do not think that rupee would be a great consideration for the Reserve Bank. I understand that the currency has been quite a discussion point. It's down almost 5% plus since beginning of the fiscal year, and we obviously underperformed against other emerging market peers, especially in Asia. But to a large extent, this is something which is warranted. This is something which ought to happen given the fact that we have been penalized much more than our peers as far as US penalties concerned. And the byproduct of that has to be a weaker current account and a weaker capital account flows. So and rupee tends to become the adjusting factor in that. So I think to that extent, rupee is basically an automatic stabilizer. I think the policymakers, both on the fiscal and monetary side, probably seem to be okay with the depreciation of rupee in a more stable form. Of course, nobody likes volatility around, but I don't think this would be one variable which should deter the Reserve Bank. And very honestly, in India, that whole argument of interest differential leading to a stronger rupee doesn't really work, at least in the near term. Now, coming to other points, we are looking at 25 bips rate cut. We have been arguing for one even after the June policy gave a 50 bips cut. We've been arguing that there was more space for the Reserve Bank to cut. To be very fair, in the second half of this financial year, RBI's last forecast of inflation would be probably undershooting our numbers by as high as overshooting our number by as high as 130 bips. So I think it will be very difficult for them to actually ignore the kind of inflation undershoots versus the Reserve Bank's own forecast have been. In fact, for the last 4 consecutive policies, they've been only revising it down, and this policy would not be any different. To be fair, both markets and Reserve Bank have sort of misread this macro cycle as far as inflation growth forecasts are concerned, which also underscored how unreliable these forecasts have become in this cycle. So I'm not sure whether it makes sense for the policymakers to actually lay too much emphasis on 1 year ahead inflation or 1 year ahead growth forecast per se, because we as Street, we as Reserve Bank have absolutely gone wrong in terms of the current macro landscape. So I think they've already communicated a relatively dovish stance in the recent discussion with the media. I understand that it still is a very close call, and there could be a split in MPC on the timing of the rate cut, but not necessarily on the on the need for the cut. For me, the bigger variable would be how they communicate, whether they cut or not, and of course how they are going to manage the liquidity infusion going ahead, because I think liquidity would be a bigger variable to watch out for as far as market transmission is concerned, and we are hoping that they would address that and probably come out with some measures in the next 1 month or so. We are expecting the Reserve Bank to infuse roughly 2 lakh crore worth of liquidity by end March to be able for them to reach a 1% of NDTL liquidity. That is what they had sort of softly pegged beginning of the year.
Okay. We are just about a minute or so away from the policy statement, and we'll cut to that as soon as that comes in. But Madhavi, just a quick word on...
Okay. And namaskar to all of you. We are in the last month of an eventful and a challenging 2025. We look back at the year so far with satisfaction. The economy witnessed robust growth and benign inflation. The banking system further consolidated, and the regulatory framework was refined to strengthen the financial system, enhance ease of doing business, and improve consumer protection. At the same time, we approached the new year with hope, vigor, and determination to further support the economy and accelerate progress. Since the October policy, the Indian economy has witnessed rapid disinflation, with inflation coming down to an unprecedentedly low level. For the first time since the adoption of flexible inflation targeting, average headline inflation for a quarter at 1.7% in Q2 this year breached the lower tolerance threshold of 2% of our inflation target. It dipped further to a mere 0.3% in October 2025. On the other hand, real GDP growth accelerated to 8.2% in Q2, buoyed by strong spending during the festive season, which was further facilitated by the rationalization of the GST rates. Inflation at a benign 2.2% and growth at 8% for the first half of this year presents a rare Goldilocks period. Globally, contrary to earlier expectations, growth has been relatively strong. Evolving geopolitical and trade environments, however, continue to weigh on the outlook. Inflation paths remain divergent, with headline inflation remaining above target in most advanced economies. Pressures in most emerging markets, however, are contained, providing them the room for accommodative monetary policy. Conflicting pulls and pressures from AI-fueled optimism and concerns over high valuations are playing out in global equity markets. Divergence in monetary policy trajectory of central banks is adding to the uncertainty on the capital flows and yield spreads. I will now come to the major decisions of the MPC and the RBI. The MPC met on the 3rd, 4th and 5th of December to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. I repeat, the MPC voted unanimously to reduce the policy repo rate by 25 basis points to 5.25% with immediate effect. Consequently, the STF rate under the LAF shall stand adjusted to 5% and the MSF and bank rate to 5.5%. The MPC also decided to continue with the neutral stance. Moreover, in view of the evolving liquidity conditions and the outlook, the Reserve Bank has decided to conduct OMO purchases of government securities of 1 lakh crore rupees and a 3-year dollar-rupee buy-sell swap of $5 billion this month in December to inject further durable liquidity into the system. I shall now briefly set out the rationale for the decisions of the MPC. The MPC noted that the headline inflation has eased significantly and is likely to be softer than the earlier projections. This is primarily on account of the exceptionally benign food prices. Reflecting these favorable conditions, the projections for average headline inflation this year and Q1 next year have been further revised downwards. Core inflation, which had been rising steadily since Q1 last year, eased at the margin in Q2 this year and is expected to remain anchored in the period ahead. So both headline and core inflation are expected to be at or below the 4% mark during the first half of next year. In fact, the underlying inflation pressures are even lower, as the impact of increased prices of precious metals in this inflation number is about 50 basis points. Growth, while remaining resilient, is expected to soften somewhat. Thus, the growth inflation balance, especially the benign inflation outlook on both headline and core, continues to provide the policy space to support the growth momentum. Accordingly, the MPC unanimously voted to reduce the policy repo rate by 25 basis points to 5.25%, and the MPC also decided to continue with the neutral stance.